In February, the SEC's acting chair announced an enhanced focus on climate-related disclosures, and then invited public comment on the guidance that's out there in March. And this enhanced focus that's being called for is to address registrants' compliance with some 2010 guidance on climate change related disclosure that the SEC had put out. And that 2010 guidance reminds companies to make disclosures about the effects of climate related legislation, regulation, and other developments regarding climate change if they're considered material to your business. It's not a rule, so it's not a legal requirement, but it's guidance that's out there. And I think the intent of what the SEC is putting out recently is to just refocus efforts on that. The other noteworthy tidbit here is that the SEC announced the creation of a climate and ESG, environmental, social, and governance task force in March. Kind of what's been out there over the last 12 months, and especially the early part of this year, were some amendments to supplementary financial information in MD&A and a host of other things. The amendments that are out there replace the requirement to disclose 2 years of quarterly information with a principles-based requirement to disclose material retrospective changes. We've got a new item 303A that articulates the objectives of MD&A for both fiscal years and interim periods. The amendments emphasize a principles-based approach to liquidity and capital resources disclosure that are focused on material short and long-term cash requirements. The amendments replace the requirement to discuss off-balance sheet arrangements under a separate caption with principles-based instruction. They eliminate tabular disclosure of contractual obligations. This is all very prescriptive stuff, so just want to make sure I'm kind of calling out the larger points. The amendments incorporate a disclosure requirement over critical accounting estimates. Lots of just tweaks here to the disclosure requirements in SK. There's also some final rules that went into effect earlier this year. The acquisition and disposition disclosure rules that took effect, those change disclosure rules for dispositions and acquisitions of businesses under 305, 314, and Articles 8 and 11. The bigger items there are the revisions to significance tests for registrants and that they would apply to acquisitions and dispositions. The significance tests are updated to revise the investment and income tests, expand the use of pro forma financial information when measuring significance, and conforming the significance threshold and tests for a disposed business. Some changes to the financial statement reporting requirements for acquired businesses. There's some abbreviation that's permitted for financial statements of certain acquisitions, codifications of current practices for acquired businesses that include oil and gas producing activity that are out there. There's some discussion of permitting the use or reconciliation to IFRS in certain circumstances that might be applicable to some of the folks on today. Like there's some changes to the smaller reporting company requirements. Just quite a bit of stuff that, again, I wouldn't consider any of it to be drastic. Probably the biggest thing there is the changes to the significance tests. I know a lot of folks in the SEC world spend quite a bit of time dealing with significance tests, and I think this is intended to streamline that to some extent. Let's talk about some FASB activity with regard to reference rate reform. Yeah, I don't have a lot of companies that have exposure to LIBOR, but I think that this is something that's going to end up affecting a lot of companies just in terms of their debt agreements and the fact that LIBOR is going away. FASB had put out some guidance in 2020 on LIBOR that when reference rate reform or the evolution of LIBOR going away and the U.S. and other countries adopting a new base rate for a lot of debt agreements, they put out this guidance that they talked about some transition issues. A lot of folks commented that the application of the contract modification and hedging requirements that were out in this ASU 2020-04 would be costly to implement, and they probably wouldn't faithfully represent management's intent in these risk management activities. The FASB kind of agreed with them and just felt like that a lot of the guidance that was out there wasn't going to be the most useful for decision-making purposes for financial statement users. So ASU 2020-04 was kind of a sweeping set of relief for reference rate related issues that were out there. And ASU 2021-01 is specific to cleaning up a couple of issues that relate to the discounting transition that involves LIBOR. And so not a lot there. I think, just in general with the effects of COVID-19 and how that affected rulemaking with the SEC and FASB, a lot of the FASB stuff that we've been talking about for the last few years probably has slowed down or been deferred. And so I think a lot of what we're seeing right now is more of just maintenance type releases taking effect this year. I did want to touch on Liveboard just a little bit. Given that the transition's been going on for a while, I don't know that a lot of folks really appreciated the fact that Liveboard is going away. And so I wanted to just touch on kind of what's the rationale there and what we're going to. So interbank offered rates, which the London interbank offered rate, or LIBOR, is one. Those are interest rate benchmarks that represent the cost of short-term unsecured wholesale borrowings by large banks. And so those rates are published for a variety of different currencies and terms. And because of the number of things that are based on these interbank offering rates, those can be things from residential mortgages to corporate bonds and derivatives, everything in between. Those rates really underpin potentially more than 350 trillion of financial contracts. So these interbank offered rates are pervasive in the contracts and financial agreements that we and our companies enter into. But back in 2007, the financial crisis prompted some concern over LIBOR's credibility because the rate was not behaving in a predictable way. It started becoming more volatile than would have been expected. And as the volume of the transactions that were underpinning LIBOR and driving that volatility decreased, the LIBOR panel banks relied on kind of hypothetical transactions and judgment. So they introduced some subjectivity into these rates. And despite the improvements that were made after the crisis in the 2007 to 2010 period, the UK's Financial Conduct Authority, who's the regulator of LIBOR, basically said, hey world, we need to transition to a more robust reference rate system around the world. So regulators in countries around the world have gotten together and have selected alternative reference rates or risk-free rates that are going to serve as alternatives or replacements for the different foreign currency interbank offered rates. So in the US, we're going to move to the SOFR, or the Secured Overnight Financing Rate. And I think one of the biggest differences between the rates that were the interbank offered rates and what we're going to in these alternative reference rates, or the SOFR in the US, is the creditworthiness of the banks that are party to these rates. Interbank offered rates incorporate some bank credit risk, whereas these new alternative reference rates will not incorporate that same level of risk. And I think the markets underpinning these new reference rates are significantly more active than what the markets were that were underpinning the interbank offered rates. So I think we'll have more concrete or definitive transactions to support these rates and eliminate some of the volatility and unpredictability of the movement in the rates. So a little background on LIBOR. I know that there's been some discussion about it. It impacts some companies a lot more than others, but I just wanted to throw out some background as to kind of why we are where we are. ASU 2019-12 takes effect for public business entities this year. It is kind of a tax-related ASU. Some of the high points of this is that ASU 2019-12 addresses hybrid tax regimes. That's a situation where you may have tax jurisdictions that have taxes based on the greater of two different tax bases. So you could have the greater of a tax based on income or a tax based on something other than income, like capital. And ASC 740 doesn't apply to taxes based on items other than income. There were some provisions in 740 that talked about situations where if you had one of these kind of greater than or hybrid tax regimes, that only the excess of the income-based amount over the non-income-based amount would be subject to the guidance in 740. So over time, stakeholders had indicated that the guidance on these type scenarios just made the application of 740 overly complex and expensive, and FASB responded and in a refreshing move decided to clarify clarify this guidance. And basically what happened was that 740 was amended with this ASU to state that you kind of flip the application of the amounts now in your 740 calculations. So instead of previously, you would have looked first at your non-income based number, and then taken the excess of the income based amount of tax above that and only included the incremental amount. FASB's amendments with this ASU 2019-12 basically say that you'd start with the amount of tax that is based on income, include that in your 740 calculations, and then exclude anything that's above and beyond that and not based on income. So I think that makes it a little more straightforward. The next kind of high point of 2019-12 deals with separate financial statements of legal entities that aren't subject to tax. So I'm thinking kind of carve out financials here. So when you're presenting separate financial statements of subsidiaries and whatnot, 740 requires that the consolidated amount of current and deferred tax expense for a group that files a consolidated tax return be allocated amongst the members of the group when those members issue separate financial statements. 740 does not state which entities would be considered members of the group for the determination of how the taxes should be allocated. And there was some diversity in practice on whether some of these non-taxable entities, like a disregarded single member LLC, things of the sort, that whether they should be presenting an allocation of those consolidated taxes or not. So this ASU 2019-12 clarifies the guidance on when those entities, those non-taxable subsidiary entities, would have to include an allocation of taxes in their standalone financial statements. Some of the other guidance that's in 2019-12, there's some discussion of the taxes on ownership changes in investments. So when you have a subsidiary that, so consolidated sub that moves to an equity method investment and vice versa, you've got some interim period accounting related to changes in enacted tax laws and how to account for changes in tax rates in interim periods, got year-to-date loss limitations and interim period presentations, and then tax basis step-ups in goodwill that come through transactions that aren't business combinations. Some things to think about there if you're kind of on the tax side of the house. And then ASU 2020-01 clarifies the interactions between 321, 323, and 815. And that specifically relates to measuring certain purchased options and forward contracts to acquire investments and transitioning in and out of the equity method of investment. There's some very prescriptive guidance there that if this is a situation where you have to transition to the equity method or away from the equity method because of an observable transaction, this is something that you would want to pay pretty close attention to. All right, ASU 2020-08, effective this year for PBEs. This one's pretty specific and provides a detailed explanation on the subsequent measurement of callable debt and whether callable debt falls within the scope of some very specific guidance in 310. 2020-10 was issued to further clarify and improve the codification by codifying all the guidance that requires or provides the option for an entity to disclose information within footnotes. I guess with all of the disclosure requirements spread out throughout GAAP, the intention here was to reduce the likelihood of a preparer of financial statements missing required disclosure. Just to tack on another one that I didn't have in the slides, ASU 2020-06 is a similar type ASU that came out that included other improvements to the codification across a number of areas, including updates to the master glossary, interim reporting requirements, receivables guidance, lots of stuff. Not a lot of new topics or changes to existing GAAP, but really just organizational type stuff and improvements that if you're in the financial statement prep world, you know, looking at disclosure checklists that are updated to reflect this stuff, and these two ASUs specifically might be something that you should spend some time on. I wanted to specifically talk about some stuff that the SEC had put out with regard to COVID-19 and disclosures. In April, the chairman of the SEC and the CorpFin director put out a joint statement that stressed the importance of disclosure and its role in protecting investors and maintaining market integrity. And their comment was for companies to provide as much information as practicable regarding their current financial and operating status, as well as their future operational and financial planning. There was some SEC guidance that came out in March that was much along the same lines. And the commission acknowledged that the risks and the impacts disclosed should be specific to a company's situation. So don't resort to boilerplate disclosure. I know accounting, there's not a ton of pride in authorship when we're drafting financial statements or filings. We tend to try and take the most efficient routes possible and use examples that maybe other companies have put out there, but the commission just cautioned you make sure your disclosures are specific. The chair and the CorpFin director specifically called out investor interest in kind of where the company stands, both operational and financially. What has the company's response been, including efforts to protect the health and well-being of its workforce and customers, how that stuff's progressing, and how the operations and financial condition may change as efforts to fight the virus progress. I think public company or not, I think the expectation is that most financial statements are going to have some form of disclosure similar to that in there. But in their comments, they specifically noted that good faith attempts to provide appropriately framed forward-looking information are not going to be second guessed by the SEC. So they're not looking to play gotcha. They just want to provide guidance and make sure that companies are putting out as good of information as they possibly can. There was also a discussion of this at the 2020 AICPA conference. If you're looking for more information about the effects of COVID-19 on SEC reporting, I think there was some good information out there